This video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all.
Right, hello and welcome to Camel Finance. I'm your boy Camel and welcome to the weekend's deep dive. On the weekend, we like to come back and re-examine the base case hypothesis of the channel and check to see if things are largely speaking still going according to plan. So as ever, we're going to run through this thing from the top, section by section, and see if things are still operating within our expectations. Now, there's a bunch of new data today, particularly around the jobs markets and the labour market. So we're going to discuss that, as well as a few other bits to look at as well. So hit the like button, make sure you're subscribed to follow along every week, and let's get into this. For the stocks, the base case was we were too bearish at the lows. We would have this big blow off top to all-time highs, and then we would come tumbling down in a global recession and a bear market, and that this would have a deflationary component to it. Fast forward to today, and this thing has taken a lot longer than I expected, but we have done a very good job at publicly trading in and out of this thing in front of everyone. We've done a good job at staying on trend. We've done a good job at selling into local highs before waiting for momentum to return so we can get back in. And that's exactly the situation we've got at the hard right edge. So who am I to doubt such a powerful trend? Who am I to stop going long here whilst this thing continues to move higher and higher? But it does certainly look to me like we are getting later and later in this major 4-year cycle. It looks to me like we are working on some kind of big blow off top now. And whether or not that forms the ultimate top and this call is correct in that we move into a global bear market and recession, or whether this is yet another local top that we can sell into and get back in after momentum returns a bit lower down, I'm still making the case that for now at least we can remain long biased and we can be looking for technical breakdowns to sell into. The long-time viewers of the channel will know that this whole idea of Congress being banned from owning stocks around the top, which will really just be akin to those guys letting themselves out of the top, just like we saw with the Fed officials back here before the 22 bear market, that seems to be coming to fruition more and more day by day as the Senate committee has now approved this bill to ban stock trading. So I think there's about 2 or 3 more steps to go before this is fully confirmed. But in my mind, if this thing can keep creeping up and then they ban themselves from owning stocks, I would suggest to you that it's probably a topping signal. So as for the stocks, I don't think we've got a problem here. I think we can still stay long and strong, keep doing us, keep trading the cycles, and I'll show you the live positions and the cycle analysis when we get to the end as always. But for now, at least for the stocks, I'm going to take this one off and say happy days, right? Long and strong, at least for a little while longer. For Bitcoin, we continue to operate under the assumption that this thing's going to throw a weekly cycle and then double, approximately speaking, off of that low. It's done that the whole way through this entire bull run, and most recently, we have come into a weekly cycle low and we've begun to double out of that low. For an updated look at this chart, you can see that we are halfway there, I think. I would like to see a bit more of upside here. I know my red box suggests that we've kind of run out of time, but if you look at the top here, this is 17 weeks, this red bar. But before we've had 19 weeks and as many as 29 weeks to the upside. So this could end up for sure taking a few more weeks to complete. I would speculate anywhere between about 2 and 6 more weeks of upside before we can start to hunt for the next weekly cycle low. So we'll see if we can do it. For now, at least, I don't really have a problem with this because it is still making higher highs and higher lows. And of course, Bitcoin can push a 20 or 25% upside move in just a couple of weeks without really breaking a sweat. So I don't think we can discount this yet. I know there's a lot of bearishness, but really when you zoom out and look at this weekly chart, I don't really see what the problem is at this moment in time. So I'm also going to tick this one off until proven otherwise. Start to roll over, fail the daily cycles, start to break down significantly. Then we can come here and say, okay, something else is probably going on. But I'm going to give this thing the benefit of the doubt for the next few weeks and see if we can get a nice big push to the upside to finish and complete the bull phase of this current weekly cycle. Then the big question becomes, can we get long out of another weekly cycle low and resolve to new highs? Or is this going to mark the ultimate top in the 4-year cycle? As I said at the start, I believe this time when we break down, we're going to have a deflationary component. And that's simply because anything you do to the M2 rate of change shows up in the CPI with a lag. Since we had this violent snapback post C19 era and all the way down into negative territory for the M2 rate of change, I have been suggesting that we will see the same thing, albeit with a lag, in the inflation data. For a long time, I think this was a pretty contentious point in the markets. Here's an updated look at that chart, M2 rate of change at the top, and you can see the inflation rate is moving in the same direction. I do believe this is no longer really a contentious argument anymore. I believe these days the cat is out the bag. All counter-trend wobbles continue to be just that, counter-trend wobbles within the context of a primary downtrend. They also continue to resolve to lower lows and lower highs on the way down. This is still clearly a heavily disinflationary trend, and I do believe this thing is still continuing to move towards a short period of asset price deflation. So again, I'm going to take this one off as well and say that the trend is still disinflationary. We are still on our way to asset price deflation for a couple of months. The CPI prints continue to come in and support this idea, as do the PPIs. You can see this trend right here mirrors the M2 rate of change, doesn't it? Down, sideways, and looking for down, starting to resume down at the hard right edge. Meanwhile, PCE as well coming in slightly hotter for year over year, but in line with forecast and is still in a heavily disinflationary trend and is extremely close to the Fed's long-term target. So again, I make the case that the Fed is behind the curve pertaining to inflation. And until such time as this chart starts to morph into higher highs and higher lows, leaving behind a sustainable bottom, then I continue as well to tick this one off and say, yep, everything is still going according to plan pertaining to the inflation part of this macro call. In the jobs market is where things start to get extremely interesting for me. There's been a lot of complexity, there's been a lot of revisions, there has been a lot of difficulty and challenges in navigating the labour market over this cycle off the bear market lows of 2022. But we have long been making the case that, albeit very slowly, the trend is clear for the labour market, and the labour market is deteriorating in real time, which of course makes up the next component of this call, which is that if we are going to head towards a global recession and a bear market, we would need to see labour market deterioration. Whilst the trend has been quite clear, albeit slow, towards recessionary territory, it was the last couple of weeks that have really revealed just how bad the situation is under the hood. For a long time, it was kind of a Camel Crew conspiracy that the Fed and the BIS have been cooking the books, okay? There was no real evidence of this necessarily. It was just some speculation that comes from paranoia from people like me. But, as I said, in the last couple of weeks, we've really started to see this turn from a conspiracy or a crackpot idea to really what seems to be the only logical explanation for what we're observing here in the labour market. The revisions for May and June came out. May was originally 144k jobs added and now sits at just 19k. June was 147k jobs added originally and now sits at just 14k. So huge downward revisions. And in the wider context, these jobs revisions wiped out 1/3 of the job growth last year, which, if true, means the Fed has just spent the last 6 months engineering a recession. And this is what I mean when I say the conspiracy is no longer really conspiracy. We've been talking about how the Fed has been engineering a controlled demolition of the financial system, ultimately with the goal of ushering in CBDCs later in the decade. And now this idea seems to be catching on with people outside of the Camel Crew. And of course, the writing has been on the wall for some time. We've got things like the Piper-Sandler recession indicator showing a recessionary look, right? Lead in before acceleration to the upside, which is also what we've been observing in the unemployment rate. It is a lead-in phase before acceleration to the upside, synonymous with recessionary periods. Whilst this thing is also throwing counter-trend wobbles along the way and one or two prints that don't look so bad, the overall trend is clear, and it's going to take persistent back-to-back improvements before we can start to discount this as an idea. It looks like it is leading towards recession at this moment in time. The same is true of the U6 unemployment rate. Looks like a lead-in before acceleration, just like other periods of recession. There has been nominal improvement up until July's print, but July's print now back to 7.9. There has been nominal improvement in the U6, but as you can see, really nothing to write home about here. The one area we do have significant improvement is the Sahm recession rule, which just printed a 0.1. So at the hard right edge, this is clearly starting to buck the trend. This is clearly starting to break back down towards the lows, and that is encouraging, right? That no longer looks like a lead-in before an accelerative pop. It looks like a lead-in that is now trying to resolve to new lows. So we'll need to see this persist, but so far this is at least one metric that is suggesting we might just be able to have a soft landing here instead of a hard landing and a recession. For the first time in a long time, it actually looks like rate cuts are going to be put on the table for September's meeting, currently sat just below 89% probability. Of course, this is calculated from the bond market futures, and it is the bond market in aggregate that determines the interest rates. So for now, at least, it looks like rate cuts are coming, but of course, we have to be aware of the wider context. Cuts into normalization, okay, can be extremely bullish. Even panic cutting historically can be extremely bullish 3, 6, and 12 months out. But cuts into a recession or a slowdown tend to be extremely bearish. And given everything else I've presented today, it doesn't look to me like it's going to be anything other than cuts into a recession. And thus, when these rate cuts show up, it is likely that the market can sustain no more than 1 to 2 rate cuts before a major top will be in place for risk assets. We've got even more complexity in the data set because according to the official numbers, the US economy grew 3% in Q2, beating expectations. However, when you look under the hood, excluding net exports, GDP was negative 2%. So how on earth do you navigate this environment as a macro guy? How on earth do you, with any degree of confidence, navigate this set of economic data? This is why on this channel, whilst we have a framework within which we can structure our trades, we tend to put the vast majority of our focus on the technical analysis and on the charts and on the cycles, because they cannot be manipulated in the same way that all these macro data sets can. Ultimately, I am a believer that the chart is the truth and price does not lie. And again, that is why we put so much focus on the charts, as you'll see when we get to the end. But overall, this to me all seems a bit suspicious, doesn't it? This to me looks like whilst we can remain bullish for a little while longer, whilst we expect higher prices and risk assets for a little while longer, under the hood, it doesn't look like things are really improving. There's 1 or 2 wobbles, right? We had U6 start to improve, but that's not happening anymore, right? We had the Sahm recession rule continues to improve. Okay, fine, but doesn't really counteract everything else I've presented today. So it does to me look like we are gradually creeping towards a recessionary period, right as I note things like the stocks, gold and Bitcoin are all heading to completion of the bull phase of their 4-year cycles. For anyone wondering, how can we hold these two opposing views in our heads simultaneously? How can we be saying we're heading for a recession and we're kind of bearish under the hood, yet we're still calling for higher risk asset prices? And the simple reason is we continue to expect to see companies beat earnings. This should provide a little bit of fuel for investors to look over the hill and start to project forward with hope, as they also start to assume that rate cuts are coming soon and easier monetary policy is coming soon. And this should help drive that final push to the upside to complete these 4-year cycles, or at least complete the bull phases of the 4-year cycles before we start to head down to those 4-year cycle lows in 2026. And when we look at things like the high yield credit spreads, which we often do, okay, we can see that so far, no real signs of financially stressed conditions yet. So long as this thing can continue to range down here, okay, without seeing a true breakout, then I think we can breathe a sigh of relief and say the market has higher to run. If this turns out to be a big spike to the upside, then expect risk to come tumbling down in the not too distant future. But for now, at least, this is not enough to be super concerned about. We also use the yield curves in a similar manner, okay? When we see the setup, which is inversion, reversion, and an accelerative sweep to the upside, that usually marks the top for the stock market. But when we take a look at an updated version of this chart, you can see that this is yet another weekly close where we have been trading sideways in a range. As I often say, sideways is fine. We can do this indefinitely and continue to not have to sound any alarms. We can see this thing trade lower and again, not have to sound any alarms. It is only really the accelerative sweep to the upside, like we saw in the C19 era, the GFC and the dot-com bubble burst, that we have to be concerned about. If we sharpen this to the 3-month yield spread, you can see as well, still hanging around the zero line for yet another weekly close. So again, no real alarm signals just yet. Start to see these things push to the upside, especially with high yield credit spreads breaking out, as I showed you earlier. Then I think we would be in cause for concern, especially if all of that is occurring with major trendline breakdowns in the stocks and Bitcoin et al. But so far, until those things start to occur, then I think we can rip higher for a little longer, as I said, because the market's going to keep looking over the fence for earnings beats, for easier monetary policy, interest rate cuts and that kind of thing, and probably mistake heading into a recession for a soft landing. Okay, so moving into the charts and the TA and the live positions, kicking things off with the S&P 500. As I've been saying, I think it's fine to be long and strong for a while longer. We are still rocking with this current position and we will continue to push these longs all the while the trend remains up. Notice how the VIX continues to move down towards our long-term target sub 12. We've been setting this trade up for a very long time, but it seems like it's well on its way to that target zone where we can get some hedges on. The Russell 2K was something we added in the longer term accounts after the tariff tantrum, and so far this thing continues to, roughly speaking, go according to plan as well. So we can't really say too much is wrong with the stock market. It's a case of long and strong continue to push there and really just searching for new places to add to existing winning positions. For the precious metals, I continue to be one of the biggest bulls in the universe for the precious metals. We've got a new cycle low in place. I believe this is a completed ABCDE, and I think going into next week we're going to start to really see some big pushes. If I put this yellow fractal of mine that I've held for a long time, I think it's going to be something like this. That's really what I think is coming. And I know a lot of people don't believe that at the moment, but when we take a look at the gold related markets, okay, silver continues to push up. So happy days there, new cycle low has been left behind. So makes a lot of sense, right? But when you look for clues in other areas of the market, Notice how we got the weekly cycle low back here, late 2024. We loaded up here in the level 3 members section with about 13 different gold and silver mining stocks and ETFs and that kind of thing. We pushed up, completed a weekly cycle, and now we continue to push to new highs. Now notice if I go back to gold, it's the exact same setup, okay? Back here, late 2024, we completed a weekly cycle. We've pushed up, got a new weekly cycle again early May, and now it looks like we are getting ready to push to new highs, just like the senior miners ETF has already shown us, just like the junior miners has also already shown us, and SILJ, of course, where we not only added back here out of the weekly cycle low in the longer term accounts, but we also added multiple trading positions along the way. This is my preferred instrument to trade and extract gains from the precious metal markets, since it's much higher beta, meaning you get far more returns and much more bang for your buck than you would via trading gold or silver, for example. So adding to winners on the way up, pushing the trades as we always do, and I don't think anyone is really bullish about what's coming here. I think by the time this thing reaches profit target, it's going to be a very, very nice trade. So that's the precious metal market. There's not much more to say about that apart from I remain bullish, and I can see a sea of doubters out there. And for Bitcoin, Bitcoin is still yet to confirm this current cycle low. It's a little bit early, but the indicator has detected a medium confluence and a medium level of momentum. That's what this mid means. So if it wants to push from here and print a slightly earlier cycle low, I'm okay with that, right? I'm positioned either way. Got lots of exposure via Bitcoin and the crypto stocks, especially in the level 3 members section. There's loads and loads of exposure in the crypto stocks here. So if this thing wants to bottom right here, right now and rip higher, who am I to argue with that, right? Like I said, positioned either way. But on a balance of probabilities, this is a little bit low here, and we have yet to break the trend line. So a couple of daily candles above the trend line will cement this low as a cycle low here. However, we do, I think, have to be a little bit open to seeing a little bit more weakness into that kind of 21st of August time frame. This would give a much more reasonable 60-day count here. And then I think we could move higher. So I'm open to that now. Where I would abandon this run-of-the-mill count into the timing window as expected around the 21st of August is, like I said, if we get some big green push here, a true trendline breakout confirmed with daily closes above. If we can get that, then I would say the actual count that the market is respecting is this cycle low here. This would just be a deviation, and then this again would be a 60-day cycle low measured from low to low, something like that, 59 days. Okay, so that's what I think is going on, assuming we can get the breakout. And if we can't get the breakout, then of course we should be able to load up here on the 21st. But a lot of these crypto related equities look bottomed. We're going to run through that in the level 3 members section in a minute, as always. And the last couple of things I want to look at is the 10-year yield, right? The chart of truth. We continue to tell that to the bond market. I know there's been some deviation because we had the whole tariff tantrum thing in here and the bond capitulation and almost like bond wars going on, where we had Asian countries dumping American bonds, forcing the yields higher. But it does seem to be ultimately resolving, doesn't it? Still lower highs, still on its way to lower lows. And really, if it occurs from here instead of from here like I originally anticipated, that's good enough for me, right? So long as the macro call of yields to new lows continues to play, then I don't really care that it took a little while longer than expected. So long as this continues to move down, I continue to sit here and say tell that to the bond market. And finally, the Dixie has left behind a weekly cycle low at long last, hasn't it? And has also confirmed it with a trendline break, right? Breakout, retest, now resumption. We've got higher highs and higher lows so far. So are we going to get a repeat of this area back here, wherein we saw the Dixie run with risk assets and the precious metals? It's not something newer investors particularly can get their head around often or have seen before. But if you've been here for a while, then you know that this is not necessarily conducive to lower risk asset prices. As far as I can tell, this macro call is still playing out inch by inch, day by day, week by week. We're still heading in the right direction for this macro call to eventually come to fruition. I still have complete confidence that my positioning and posturing and my live positions and trades are justified and that I am on the right side of the market. And as ever, we'll continue to head into next week completely open to all possible outcomes, completely unbiased, and willing to adapt and pivot to new data if it presents itself. And of course, we'll be back on Saturday again to run through this thing from the top and check the new data as it becomes available to make sure that things are still operating inside our base case hypothesis and expectations. I hope you have a fantastic rest of the weekend. If you're a level 3 member, look out for the members video I'm about to post for you guys. And until Monday, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see. Rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame. Sticking to his guns in his money game. He's a badass, oh yes indeed. Camel